Understanding economic statistics is key to making informed decisions in financial markets. Whether you're trading currencies or precious metals, knowing how economic indicators like unemployment claims and unemployment rates can influence the market is crucial. In this video, we'll dive into the US Unemployment Claims Index, the unemployment rate, and how these figures affect gold and the US dollar in the forex market. Let's get started. First up, let's talk about the Unemployment Claims Index. This is a weekly report published by the US Department of Labor. It measures the number of individuals who file for unemployment insurance for the first time. Released every Thursday, it's a valuable snapshot of the US job market. When claims rise, it can indicate economic trouble, but when they fall, it signals improvement. Since the US economy plays such a significant role globally, changes in this index can affect the value of the US dollar as well as other currencies traded in the forex market. Now let's move to the unemployment rate. This metric tells us the percentage of people actively looking for work but not finding it. A high unemployment rate is usually a sign of an ailing economy, while a declining rate shows growth. Traders closely watch this number as it often signals future market movements. If the unemployment rate drops, central banks might raise interest rates, which can strengthen a country's currency. And let's not forget about the different types of unemployment. We have frictional, cyclical, and structural. Each tells a different story about the health of an economy. Next, let's talk about gold. When the unemployment claims index rises, it could mean an economic slowdown or even recession. This often leads to higher market volatility. In these times of uncertainty, investors tend to flock to gold, viewing it as a safe haven asset. But when claims decrease and the economy starts improving, investors are more likely to take risks, moving away from gold and into stock or other assets. Of course, the US dollar is also highly sensitive to these economic indicators. When unemployment claims rise, it can signal economic trouble, which may weaken the dollar against other currencies. On the flip side, when unemployment claims decrease, the dollar tends to strengthen as investors gain confidence in the US economy. To sum it up, paying attention to key economic indicators like the unemployment rate and unemployment claims index can provide you with crucial insights into the market. Understanding these numbers allows traders to make better informed decisions, whether they're trading currencies or precious metals such as gold. By staying ahead of the curve with economic data, you can navigate the financial markets with more confidence. Thanks for watching, and don't forget to subscribe for more tips on trading and market analysis. See you next time.